Thanks for joining. We're going to have an amazing session here. I'm going to filibuster for a bit up front just to allow folk to join the webinar. We have two amazing speakers, and it's a topic that is incredibly germane to our community. Very excited about today. Maybe I'll just start out with just setting things up on my end. I'm Gary Schwartz. I'm the president of the CLA, the Canadian Lenders Association, and obviously super excited to moderate today's discussion. What we've done is we're positioning a number of thought leadership webinars leading up to next year's Auto Finance Summit that we hold in conjunction with the International Auto Show in February. So we'll see you all there in person, but we wanted to sort of get people thinking about themes and thread the needle a bit leading up into that. And this is one of those sessions. Today's webinar is called, Breaking the Margin Squeeze, How AI-Based Pricing Can Redefine Canadian Auto Finance. And there's a lot to unpack here. This is, as I said, a very germane session. How lenders stay profitable in this increasingly competitive and rate volatile market is a key topic. The auto finance industry, we know, is in a process of modernizing. We're at a crossroads. There's a big squeeze. It came up in our last summit where we talked about, high borrowing costs, shifting consumer demand, obviously rising competition, with the digital economy, with a number of channels opening up. And yet, as always, I like to say that challenges in our community are always looked at as a massive opportunity to innovate. The Canadian Lenders Association is built on innovation, especially in this discussion. We can hone in on pricing intelligence and data-driven decisioning, and to that end, we pulled together two experts that live and breathe this every day, with Will and Keith. So the Will, represents a global banking for Earnix, and Earnix is a approved vendor of the CLA, and I'll let obviously Will go deeper, but they specialize in helping financial institutions leverage AI and advanced analytics to optimize pricing. So that's the topic of today. And then Keith Hickey is the president of Torwood Consulting, and we know Keith because he was a former TD Auto Finance executive and sat on our auto finance roundtable at the CLA. So a warm and old face in our community, and brings obviously years of experience managing lending portfolios, and I guess the dealer relationships behind those, right, Keith? And today we're going to talk about obviously your deep understanding of profitability strategies through all types of economic cycles. And so I'm really excited to have both of you here. One, I guess, is going to lean into the tech side, and the other one is going to lead into sort of the real world experience on the ground through your career, Keith. And I think it's such an important conversation, and one that doesn't happen enough in our community. So what I'd like to do is sort of set the stage. And so maybe as a way of personally introducing yourselves, Will and Keith, I asked you to put together a few slides. I think that's really good for the community to just get a sense of getting the building blocks in place for the discussion. So I wanted, Will, I know that you put together a few slides with Keith. If you could maybe share that and walk us through that so that we can start unpacking some of these ideas.
Yeah, absolutely. Thanks, Gary. So as you so politely introduced me, my name is Will Ely. I work for Earnix. We provide solutions in pricing, decisioning, and pricing deployment in the retail lending space. I have been with Earnix for about 10 years now, and currently lead our professional services team and our solutions engineering team. So I get the benefit of seeing what all of our customers around the world are doing with our software, as well as taking all of those exciting use cases and helping identify the best ones for our prospective customers. And I'm also here with Keith Hickey as well.
Hi, good afternoon. Keith Hickey. So I have my own consulting practice, Torwood Consulting. There's a mighty team of one. So my background is 35 years in banking, in Canada and a little bit in the US as well. But most notably the past decade, I've been on the leadership team of TD Auto Finance and had several roles there, including leading product. So yeah, I think I have a pretty good understanding of the industry and some of the opportunities and pain points that you experience every day. So I'm going to leverage that to help you understand the perspective on this sort of AI, advanced analytics opportunities with the use case and pricing. So I'll start with just setting the stage in terms of where are we today and where are we going. I think the where are we going part is perhaps the main part of the content, but in terms of where we are today and setting the stage, I think on the next slide, well, there we go. So yeah, as you know, we've had a lot of ups and downs in the past 5 years during COVID. I'm not going to focus on that because you hear that in every presentation and every webinar that you're on. But safe to say that I understand, the pain points and the ups and downs that was created through those learned experiences. Now, when it comes to pricing, and that's what we're pretty much focused on today, the way that we price loans in Canada is pretty unique. As you know, the core pricing mechanism is a monthly rate sheet. And, of course, those monthly rate sheets are sort of augmented with special rates sometimes, or seasonal rates, or even ad hoc changes. But for the most part, it's a rather, it's a set pricing for the month. And obviously we react at minimum monthly on rates. The dealers are really in the driver's seat on the actual interest rate that's given to the consumer. As you know, they have lots of choice in terms of their lenders, and they leverage that ability and choice to optimize their compensation. But the rates also, the higher the rate they are able to sell, the higher the compensation they get. So there's a correlation there and an embedded incentive, for these markups and so on. So that's something to keep in mind. The overall approach, because the rate sheet, obviously there's a different rate sheet for every core segment: prime, non-prime, and then if you're in the rec space, there's going to be separate rates for those, of course. But for the most part, the rate environment is relatively flat. So, the challenge, as everyone knows, is that, how do you get efficient risk-based pricing in an environment where you're not able to assign a specific rate and a specific, compensation for the dealer at the deal level, and it is very difficult. So it is a drawback in the way that this approach that we have. It is basically a legacy approach. Most other countries have moved beyond this and are now using risk-based pricing based on each deal. And I think that we want to sort of talk about that and think about the impacts and the opportunities around that. Also, in order to make the pricing and the ROEs on our portfolio work, there's a lot of sort of incentivizing quality deals so that you can influence the composition of the portfolio in a positive way by incenting higher quality deals. And in my experience, there's a plethora of incentive plans based on individual dealers or OEMs or independents versus franchise, and all of this is it's a full-time job for many folks in the product area to keep on top of these, to make sure they're relevant and we're paying fair compensation. So, but at the end of the day today, what we're really going to discuss is an opportunity and an innovation pathway that we will pay dividends out of the gate in terms of the legacy approach that we have today with rate sheets, while building a new way of pricing loans. And maybe the benefits of that in the short term are more about insights into the portfolio, but the longer term opportunity of course is to unlock new capabilities in terms of delivering customized rates to the dealer, both on the rate and on the compensation.
Thanks, Keith. And it's been great working with Keith, getting kind of the inside scoop on the intricacies of the Canadian lending market, because we operate all around the world, and there's always some idiosyncrasies in terms of the delivery of the prices, the intermediary, and that dealer's incentives and that dealer's behavior. And it's not necessarily about creating the world that we want, but working within the world that we are doing business today and finding those levers that work to incent the kind of dealer and consumer behavior we're looking for. So whether it is more granular pricing or more granular and precise dealer incentives, I think it's really exciting as we get further into the Canadian lending environment and find opportunities to leverage tried and true tools in a unique landscape. And I say unique landscape, but as we can see, as we look at kind of the pressures on auto lending, a lot of these are common across industries, across markets, across geographies. But we see challenges facing financial institutions, like the system of delivering physical rate sheets once a month, which means that we are deploying prices in a way that doesn't allow us to react as quickly to market changes as you might in other markets. We see policy constraints that we need to make sure that we're staying inside of, and that's something we see everywhere. There are different constraints, but there's always that consideration for governance, compliance, making sure that we're delivering fair deals for our customers that also work for the bank, and the kind of broad dealer discretion. We see this everywhere in the world. I was just down in Brazil last week dealing with very similar challenges where the lender has control over the rate that gets to the dealer. But there's always a little sort of cloud of uncertainty around what is going to reach ultimately the customer. And what we also see as a challenge for a lot of financial institutions is a lack of clarity around simulation. So what's going to happen if I do this? If I change my rates in a certain way, if I increase my incentives on a certain credit segment or a certain geographic region, what can I expect to happen? And how will I know if that strategy has succeeded or not? So along with these sort of market-driven challenges, there are also analytical challenges around understanding, what's going to happen when I do this, and or what should I do if I want a certain outcome? And those challenges have been sort of in a pressure cooker lately over the last few years as markets around the world deal with concerns around vehicle affordability, driven by rising interest rates, rising cost of vehicles, changing consumer demands and wants, and rising auto delinquencies. So as we face those challenges, the goal of kind of increasing margin becomes sort of a little bit more urgent. We find that there's always a little bit more demand for more precise analytics, rapid strategic deployment in markets as they start to change, as sort of established lenders start to face new pressures and a faster moving competitive landscape. So very excited today to walk through kind of the tools that we have available to help lenders face these pressures and the way that we've seen other lenders deal with them in a very successful way. So, I think from our perspective, I think a lot of this kind of meeting these challenges is built on top of agile and intelligent pricing and decisioning strategy. So what we offer is a unified platform for analyzing and simulating the impact of changes in pricing and or decisioning rules. And that includes pricing with respect to the rate sheet that's going out, as well as other components of pricing and profitability, like the dealer incentive structure. So when you have a platform like that, you are able to simulate and forecast what you expect to happen as you adjust your strategies. And then you're able to very quickly test and learn. So we never expect to, deploy a single perfect strategy to the market and have that work forever. So along with the ability to be very intelligent about your forecasts and your strategy design, you also need to be very agile in terms of quickly assessing, I've put this strategy out into the market. Is it working the way I expected? And if not, why is that happening? Is it a shift in the market? Is it drift in the models? Is it a shift in my customer base? And what do I need to do about it? So being able to put these capabilities together in a single kind of purpose-built platform allows lenders to kind of complete this cycle very quickly. We see in many places and many kind of established businesses where this process of making decisions about what do we want to do with our prices, generating forecasts, deploying them to the market takes place in months, sometimes, or at least weeks. And we can shorten that cycle by simply making it easier to have all of the models in one place, have that deployment mechanism in one place, so that we can very rapidly kind of design a strategy that we think will work, assess the way that it's performing in the market, and then quickly deploy updates as the market inevitably shifts. So wouldn't be financial technology if we didn't wrap this in very rigorous governance and compliance, automatically generating audit trails around every piece of this decision. And ultimately what we see is lenders being able to use pricing, to use dealer incentives as a very powerful lever to drive their portfolio in the direction that they want, whether that is a pure profitability play, whether they're looking to increase market share in a geographic region or a new credit segment or a new product or loan term. But pricing is a very powerful lever out in the world of retail lending, and we're simply enabling our customers to use it in the most effective and agile way. So what that looks like, in a really quick snapshot, is a platform that allows you to rapidly build and monitor models without coding, without intervention from a team of experts who will unlock a black box for you, run real-time simulations of what we can expect, create pricing optimization strategies where, for example, we might say, hey, I'm willing to let all of my prices move up or down by 50 basis points. I want to hold my booking probability constant. How can I maximize my net interest margin with a new pricing strategy? And then likewise work towards things like expanding pricing granularity and visualizing an efficient frontier of possibilities with optimized pricing to help lenders balance and prioritize volume, profitability, and risk profile over time. So again, this was, my hope here was for Keith and I to give you a broad overview of the Q&A we're going to be jumping into, sort of what kind of challenges we're seeing, what the market looks like, and what some solutions might be. So at this point, I will invite our moderator to start lobbing some questions at us.
I like it. So you Will, you were talking about this sort of pressure cooker, and I know we're all in this pressure cooker, right?
Mm-hmm.
Rates are volatile. You've got consumer affordability, which is stretched right out there. You've got dealers are pushing hard to keep customers in cars, right? So
yeah,
every basis point matters, is what I'm hearing, right? So maybe I'll throw this to Keith. You've obviously seen this firsthand through your career. From your perspective, what are the fundamental challenges facing the auto lender right now? They're on this call, right? So what are the traditional pricing strategies? Why are they not enough? Like, why do they have to look further at retooling?
Right. Good question. So I alluded to it in my opening in terms of the structure of the rate sheet focused pricing regime. I think in this environment where cost of funds, which is directly correlated to bond yields, are up and down based on a tweet or a truth, there's a lot of volatility mid-month. On after you press go on that rate sheet, a number of things can and do happen that impacts the yield and the margin on your loan origination. So that's definitely one thing. And everyone's adapted to that by, pressing their product groups and the pricing analysts and anyone who they can corral to, do another ad hoc analysis, scan the market, and sometimes make changes mid-month or whatnot. But ultimately, it's a lot of work, and it takes away from some of the core initiatives within the product group and the pricing group. So the other thing too is, basically the approach is inefficient and outdated. Many other markets in the world have moved away from more static, and it's not fully static because there is some reaction, but a more dynamic pricing approach. And the way it is now is, again, the dealer's in the driver's seat, and because margins have been, like, reserves have been going up steadily for the past many years, and margins have been coming down likewise. It's not an emergency, but it's a trend that we would hope to break at some point. And and hopefully some of these tools might give some thought to avenues that could make that happen. Some of the things that the way that lenders are reacting and trying to deal with constrained margins is to focus on scale, which means more volume, usually more incentives, and a focus on relationships and so on. But there's definitely a race and an intense competition on each deal to maintain scale, right, which is a big part of having a profitable operation. Right. Sometimes that leads to maybe excessive compensation. Sometimes it leads to stretching the underwriting envelope and adding a bit more risk than may have been modeled. So yeah, there are a number of negative outcomes from that.
Okay, let me flip this to Will for a second.
Yeah.
So, from a technology viewpoint, then, so we obviously know that the industry hasn't fully adopted, sort of a modernized approach to pricing. The static rate sheets, the outdated, dealer reserve models. Why are so many lenders relying on this? Like, why hasn't there been a flight to modernization? Why hasn't the Canadian market kept up with sort of a global modernization around these tools?
I think we see inertia and legacy processes wherever we go. And I think in the Canadian market, as Keith has called out, there is such a culture of dealers having a broad leeway to make decisions about the ultimate financial instrument that gets signed by the customer and funded by the bank. So, I don't ever expect to come in and change the way fundamentally an industry thinks about the relationships between lenders and dealers and customers, but rather find opportunities to leverage those very strong relationships and that very strong culture of dealer autonomy in a way that works really well for lenders as well. And I talked about this before, and I don't think it's necessarily ripping up the monthly rate sheets and throwing everything into a big black box, writing AI on the box and plugging it in and replacing the dealers, but rather it's using analytics to really understand how do these levers work? What happens when we move the levers on the rate sheet? What happens when we make adjustments or add granularity to the dealer compensation structure so that we can work within this existing market, this existing environment, but leverage those things that the lenders have control over in a way that, while still working for the dealer, still working for the customer, also help those lenders originate the kinds of loans at the prices that they want that fit their goals, both short-term and long-term, for volume, profit, and risk profile.
So I'm going to stay with you because I think people want to, dig deeper. So, so you're advocating for analytically driven pricing, right? And obviously this involves continuous learning systems, right? So can you walk us through, because I think what the audience wants to hear is, okay, you got me interested, but walk me through what this means in practice for me as a lender. How does AI-based pricing operate within our workflow? Because you're saying, look, we don't want to throw the baby out with the bathwater. We want to work within your existing lending workflow. We want to work within the existing market realities. Just give us a snapshot of what that looks like.
Absolutely. And I agree. I think it is very important to meet the lenders where they are, and provide tools that make the processes they're going through today that much more efficient and that much more effective. And so to me, the first step is really kind of understanding what a given lender's, say, pricing process looks like. So from the moment you say, I know I'm going to change my prices on this day, what does it look like? What kind of data are you looking at? What kind of forecasts are you looking at? Who's involved in that process? And what are the metrics that they're interested in? And what we then do is we take those and we sort of formalize those within our analytical platform so that that lender can be saying, when that lender is asking, as they're asking today, what do we think is going to happen if we make this change? You can very quickly click a few buttons, slide a few dials, and get an analytically driven forecast of how we expect a given price change to impact demand in different segments, profitability in different segments, and likewise the dealer reserve that you are paying out. Likewise, after those prices are deployed, there is inevitably some process that takes place where we're evaluating, did this work or not? And what we're doing is we're allowing lenders to perform that evaluation, A, much more quickly, but B, in the context of those historical forecasts within the same platform, so that if there are variances, it's very easy to identify where they came from. And likewise, you have the data in front of you if you need to, say, refresh your customer demand model, or update your predictions around the mix of customers you're going to be seeing walking into your business. So really, day one with us going live with our customers often involves the same people and the same processes they had before, but the decision making is based on more analytically driven outputs.
Got it. So Keith, from your perspective, and this is kind of the flip side of the same coin, is from a business perspective, what does that mean? So lenders now, according to Will, they're able to see and act on different data, different. They have binoculars, they have night goggles, whatever the metaphor is. What does that translate into for a lender, like from a business perspective?
Yeah. So today, most lenders monitor obviously their originations on an ongoing basis. Volume, of course, and average credit score and those types of things. Yield, definitely, all of those. So this is really just taking it to the next level in terms of looking at that and having a much larger data set within a platform, cloud-based platform, that you can triangulate more precisely, I would say. Like, for example, if you have the historic portfolio data in there, you have the application data in there, you have market intelligence. So for example, you could say, geez, I wonder if I'm able to price deals, in the simulator deal by deal, show me the deals that are most mispriced in terms of the rate and or dealer compensation. I could see, you're probably going to come up with a pretty big list of, for example, I'll look at the dealer compensation side. 15% of your portfolio, you may have overpaid materially for the risk of that deal based on the probability of default and loss given default of the structure of that deal. So, you know,
Keith, is that going to give you an edge competitively? Is that another plus from a business perspective that now you're edging out your competitors?
Yeah.
With that?
I mean, my example, was more of a risk off kind of,
right.
Action. But on the other hand, on the other side of the ledger, there's going to be, deals where maybe we didn't pay enough and we lost them, and they were high quality deals. So you can start to tweak your dealer compensation model and make it more risk priced, even in the legacy approach that we do. So that's sort of one of the benefits out of the gate is it's really about insights. At the at the cell level of your portfolio, and if you find enough of those little opportunities and act on them, it will have a big impact on the overall yield and risk return of the portfolio.
Got it. So now I know, I just know my audience, and I know that they probably all saying, well, this is super peachy keen, but it's, I'm in stasis because it sounds incredibly intimidating, right? You've got this agentic solution that is giving me all this data, but Will how does somebody go about it, and what is that right balance that they need to strike between the risk and the margin and volume? Like, what kind of data foundation do they need to get going and feel comfortable?
So this is one of my favorite questions to get when I am in front of prospective customers. Because when you start talking about data-driven solutions, analytics, and AI, they immediately begin imagining this sort of enterprise-wide data scavenger hunt. We're not asking you to go on a scavenger hunt. Typically, the data that we need to get this going is essentially that data on which customers have we approved for loans, what was the price we quoted them, and did they book or not? And the great news is, it's funny when we talk to data scientists, they start thinking about, well, how long is this going to take? Typically, it's about a 6-month data window. And for folks who are used to thinking about models in terms of, say, credit default, when you're trying to collect data that will allow you to predict who's going to default on a loan, you need to wait for people to default on loans. That can take a couple of years. But when we talk about this world of elasticity modeling and demand modeling, we know really quickly who did and did not accept the loan. So typically, this data is already sitting inside your loan origination system. It's a quick extraction, and then we plug it into our methodology, where we use that data to understand, how are different customers different in their sensitivity to price, in the profile of their profitability, and how can we leverage those differences in customer behavior and price sensitivity to develop pricing strategies that work best for both the lender and the customer. So it's, people are expecting a very intimidating data extraction exercise. Likely it is sitting right there in your loan origination system. It may be something that you look at every day and every week. We can take that, and to us, that is gold.
Okay, so let's stay on that idea of talking about analytical driven pricing. What a lot of my lenders talk about is that they've got a large operation, they've got siloed operations, and you have credit risk on one side, you've got pricing on the other. Having consistent data and analytically driven data, can that help sort of create close the gap, create consistency across both those areas of business?
Absolutely. I think first there is sort of the necessity where it's, hey, we are approaching this in a different way. we need to be in the same room together sometimes. But the other thing that we see is that, you know, in the past, this process of producing forecasts that involve folks from the pricing team and the risk team, it can be kind of painful. It can be time consuming. And it's the sort of thing that if you were to tell these folks, hey, we need you to be doing this once a week, they would not want to do that. That's fairly painful. It's a lot of legwork. And so what happens, we see, is that as they realize this process is easier, as they realize we've, you know, cut out roadblocks and streamlined and automated a lot of kind of the legwork, the disconnected systems, the disconnected teams, it makes it something that they're more willing to do more often, something that they sort of start to get in the habit of, where they might say, well, I want to check with risk. And instead of thinking, I want to check with risk, but that's probably going to take a while to get on their calendars, and I don't know how they're going to get their models into our platform or into our process. They know that, hey, I'm going to check with risk. I'll send them a ping. It'll take us 15, 30 minutes this afternoon, and everybody can get on with their day. So it's, you know, the technology enables a lot of analytical functionalities, but what it also does is make these very important processes a lot more approachable and the sort of things that folks get into the habit of doing more often.
Got it. I'm going to throw this out to both of you, and I don't want to go down a rabbit hole on this one, but I just want to get it out there because I know that probably a few folk are thinking about it. Is you can't talk about AI without talking about fairness, without talking about explainability of models, right? And how do we ensure, I guess the word's transparency. How do we make sure that there's transparency for folk in the journey? So the dealers, the customers, how do you tackle that? And you know, any of you can, both Will and Keith, you both can jump in on this one, but maybe just speak to that for a second.
Yeah, I can go first. So yeah, I mean, fairness, when I hear that word, because I did some work in the US, I think fair lending, that doesn't exist in Canada in the same degree. Although, you know, the environment is changing with the advent of the new financial consumer agency. So, you know, we don't know for sure what's coming down the pipe there, but you know, there could be future risk in terms of our pricing regime as it is. But you know, at the end of the day, I think you know, having a platform with algorithms that derive prices, you know, certainly increases your explainability. And you know, if there's issues there, we can address that through changes to the algorithm and to the approach. But I think it improves the overall situation.
Got it. Will, do you want to add anything, or we should just get into, you know, the actual practical, you know, approach to this? But if you want to add anything to that.
So yeah, just very quickly, I would say it's about transparency, and the key words for us are supervised learning. So we're not plugging in a black box and letting it just go to town. This is a tool that allows you to A, see every single piece of information that went into a decision, and B, there is always a human in the middle before a change is made. So again, I know that there are different views on and different sort of impressions of what AI is. And I think in this case, it's very much a transparent and supervised analytical process. And to Keith's point, when it comes to explaining, say 2 years down the road, why did you quote Will 12% and Keith 10%? It's a lot easier to explain that when all of the analytics that drove that decision live in one place. And live in a platform that was very specifically designed so that you can answer that question, whether it's tomorrow or 2 years down the road.
Got it. And that makes sense. I mean, to be honest, the biggest black box we have is a human. So anyway, so let's get practical. Okay, so how do I make this shift, right? So you know, maybe you know, to Will, you know, when a lender decides to modernize their pricing infrastructure, you know, where do they begin? I guess that's a good sort of storytelling opportunity. Where do you begin? What are the first steps that actually move the needle? You know, I'm starting it. I bought in. Hey, Will, you're great. It sounds super. I'm all in. Where do I start, and when do I see results?
Well, that's great news, Gary. I'm really excited to get started with you. So I think really what it is we meet the lender where they are. We start with building out their existing pricing process, their existing pricing structure, and typically the first thing that we add in is this estimate of customer price sensitivity. So lenders are very finely attuned to risk, have a very precise estimate of the risk and expected cost of risk of each loan. And typically, the kind of incremental analytical sophistication that we bring on day one is incorporating, okay, we understand that this customer is likely to cost a little bit more than this customer, but how will they respond if we raise the price on one of them to accommodate that cost? So it's layering in that understanding of how do we expect the customer to respond to a change in price? And then likewise on the dealer side, you know, we have these dealer incentive structures, and folks typically have a broad understanding or estimate of how a change in that incentive structure may impact the volumes that they're booking. But putting some rigorous analytics around that is, again, one of those foundational steps. And typically, you know, I won't tell a very long story, but our approach across nearly every lender we work with is an approach of iterative improvements and sophistication, because we understand that along with this being a very powerful technology, it also can represent sort of a change in the way of thinking, a change in the way that things are getting done. And so it's about letting the organization kind of digest what it looks like to start taking into account these additional factors. And then also letting the organization tell us, hey, here's the next step we think would make sense. So it's, you know, it's working together with those customers so that, you know, we're with them for each step of the journey and identifying where is the best next step for you. So it's not, you know, we don't want to let perfect be the enemy of good. We want to identify those opportunities for iterative improvement and then continue on a path of increasing that sophistication based on capacity and need.
Right. And I guess if you're customizing it for the end consumer, you better be able to customize it for your client as well. So it's part of that philosophy of personalization. Okay, so maybe this is a question for both of you, but you know, I'm a bit of a curmudgeon, misanthrope. So whenever a person is in the mix, I always think there's problems, right? So I know that transformation always comes down to the people, the decision makers. So what does that look like? So I've got this agentic solution, whatever you want to call it. I've got this AI, it's an analytical tool, and people have to use it. We've talked about that continually, right? What cultural and organizational changes, if any, have to be made? You know, when you're training, when you're incentivizing, you know, how does leadership play a role? You know, what makes this stick, or maybe what makes this work? Any of you can jump in.
So I'll jump in. So I think, you know, I often think about this as selling someone a race car. There is a process of training, and training is a huge part of our approach. We want our customers to be as comfortable as they can be, but there's a part of the training where it's learning which buttons do I press. How do I operate different functions of this platform? And to me, I think about that as, okay, here's the steering wheel, here's the gas pedal, here's the brake, here's the gear shift. So what do I do to make this thing go? But then the next piece of this, which I think is probably just as important and perhaps even more critical for getting that buy-in, is how do I use this? It's less about, how do I make this thing go faster, but, when do I accelerate into the curve? When do I draft off of my competition? And when do I go for the pass? So really what it is, it's about, how do I use this thing? How do I operate it? But also, what do I do with this thing out in the wild in a way that matches with my business goals? So, my team, I lead the implementation team as well. They work with our customers post go live to make sure not just that they know which buttons to press, but also that they know what kind of strategies they should be implementing, what kind of outcomes analysis should they be performing, and how often, to really get the most out of this technology instead of just, well, I know how to make it go and I know how to make it turn.
So maybe this is a good sort of, a lead into a bigger question I have, which is, what are those KPIs? Like, how do I tell, what does success look like? I asked in the beginning, where do I start? When do I see the needle move? So the context of this one is, when do I see that lift that I'm looking for? Is that does that vary based on the customer? Is it should I be seeing positive results out of the gate? And Keith, you're welcome to jump in here as well, because this is a business question. What should I be looking for? Is this a long-term? You talk about iterative process, which immediately flags a little bit slow. What would you say, Keith?
Yeah, I mean, I would, we've done this before. All of us have done this because once upon a time, and I'm old enough to remember the way we underwrote, was a grid basically on a couple of pages, piece of paper that was memorized by the underwriters, and so you had the grid and you had a bureau. Obviously everyone has innovated way beyond that and have automated algorithms and complex strategies that dissect the risk and estimate it. Right. It's very similar exercise now. We're going from a rate sheet to something that has much more granularity and can price at the individual cell level. So we've done it before and we can do it again. And if you think about how that transition happened within the lenders today, well, obviously, you have technical expertise in terms of modeling and analytics and so on. There may be a need for, to beef up that part of your team. It's a collaboration between product and your data analytics team. And, we already have lots of those folks. Some of those redeployed into a pricing use case and iterate from there.
It's a good point, because what you're saying is, even though maybe Canada's behind and we're a little slow on this, we've tooled this before. We've gone from an abacus to a calculator. We can go from a calculator to an authentic solution, and then so they're the same learning tools, and I don't see why somebody couldn't adopt this and see results right out of the gate. And it's super exciting. And I know we're sort of coming up to the witching hour here, and it's been a lively discussion. I wanted to let everybody know that, we recorded this. We're going to make that available. We're going to turn this into an op-ed in the Canadian Finance News. This will be an ongoing discussion, so we're not going anywhere. You're going to see this pop up as a discussion in the Automotive Finance Summit in February. I dropped the link to our financeevents.ca website, where we host all our summits. So, sign up now. It's super early bird. And it's very exciting where AI is taking us. I'm most excited about the point where we don't use the term AI and it just becomes the water we swim in. because I'm like you, Keith. I got a few gray hairs, and I've gone through a few cycles, and I know that each cycle of technology, you get fixated on a term. This is going to become just the way we do business. And so the sooner we start, fumbling and learning and A/B testing, and the better. So I can't thank you two enough for joining us and starting this conversation. I don't know if there's any sort of closing, advice to the lenders that you haven't given. But maybe in closing, I'll ask you guys, words of wisdom, sage advice that you haven't been able to convey over the last hour. You've got literally 2 minutes to change the world.
Yeah, I'll go first. So yeah, I mean, in a way, this can be scary, especially the word AI, as you alluded. But ultimately, moving into a pricing optimization algorithm kind of environment, in the initial days, you're going to extract insights that you can leverage in the current, pricing environment and or underwriting environment, because there are different levers you can pull and push. If something is mispriced or overpriced, you can identify opportunities as well in terms of increasing a little bit on the dealer comp and getting better quality deals. So yeah, think of it that way. It's like you're getting on a technical platform that has a lot of runway in terms of its innovation and opportunity for change in a bigger way down the road.
Well,
I'm on mute.
All I will add is my thanks to Gary for hosting today. Thanks to Keith for joining. And if this piqued your interest, I would love to hear from you. So thank you to all of our listeners, and would be delighted to continue this conversation in the future.
Thanks so much, Will. Everybody, go in, get your early bird tickets for the Auto Summit. And by the way, just as a drop the mic, on the November 24th, around the corner, we have the Sustainable Finance Summit as well. We'll see you at one of the events, and I look forward to catching up in person. Thank you so much, Keith and Will, for your time today, and we'll see each other soon.
Thanks,
Cheers.
Gary.
Bye-bye now.